everybody, and welcome to HardAssetsInvestor.com. I'm Mike Norman, your host. Well, who is regulating the 600+ trillion derivatives market, or at least overseeing much of that, is the Commodity Futures Trading Commission. Here to talk about it is Bart Chilton, Commissioner. Bart, thanks very much for coming on the show.
Great to be with you as always, Mike.
It's an enormous market, the derivatives market, and it is under now more regulatory scrutiny through enactment of Dodd-Frank and new regulations. Tell us a little bit about what's going on in terms of any new regulatory activity.
Well, in general, we've done a pretty good job at my agency, the Commodity Futures Trading Commission, so on futures and on swaps. And, of course, swaps were where the big problem was with the economic meltdown, credit default swaps, etc. But overall, by the way, with all the financial regulators, the Fed, the FDIC, the SEC, not much progress has actually been made. It's almost 3 years since Dodd-Frank was passed, 2 years since we were supposed to have all the regs in place, and only 37% of the rules and regs have actually been done. As opposed to speeding up to get them done in the last year, regulators have slowed down. So I'm concerned about that. Our story at the CFTC is a little bit different. We bring up that average because we've got around 70% of our rules done, and we've made big progress. And the big thing right now is how do we deal with risk that is transferred, that takes place overseas, so an affiliate, for example, of a U.S. bank, that gets sometimes it gets traded back or sent back. It resides in the U.S. So if you look at AIG from back in 2008, we bailed AIG out $180 billion. And that risk, and it goes both ways, by the way. When Lehman Brothers went down, that went back to the EU. So these are cross-border issues. It's not just a U.S. issue, and we're working hard on it.
What happened in the case, and this is post Lehman Brothers, was post AIG. Supposedly, we were looking at this stuff more closely, but you had MF Global fail. You had the JP Morgan whale trade. It's still out there, and it's out there in numbers that are huge and potentially represent a threat again to the financial system, where one of these institutions are going to have to be bailed out. What are we doing about that?
You're absolutely correct. And there's another one, and maybe it's not systemically important, but when you mentioned MF, Peregrine, which was his firm in Iowa, $200 million, so it's not a systemic risk to our economy. But, the guy duped regulators with Photoshop and a P.O. box. I mean, crazy stuff. And so we're doing a lot to try to catch the bad guys. We're a little bit under-resourced. Everybody in government always thinks they're under-resourced, but we are significantly under-resourced. So a lot of bad guys get off. By the same token, what we're doing in the futures and swaps areas with clearing, that is making sure that there's sort of a socialized pool there to take care of, a socialized risk pool to take care of trades, to make sure people will be good. Clearing, added capital and margin requirements so that we know people are solid themselves, with pre and importantly post-trade transparency. So the trades and benchmarks like LIBOR, etc., are based upon real trades, not something somebody can make up, or in the case of Barclays, UBS, and RBS, something they tried to push around. And finally, on customer protection, and that is with regard specifically to segregation of customer funds. So MF Global and Peregrine, what happened in those circumstances is customer funds are supposed to be segregated and safe, sacrosanct. And that wasn't the case. So we're increasing our oversight and regulations with regard to customer segregation as well.
Now, you mentioned the slow rollout of these reforms, and one reason, an obvious reason, is you have some formidable opposition. That's Wall Street, okay?
They do,
and they do a tremendous amount of lobbying, and I don't think they want to see these reforms because, it impacts their business, and they've been standing in the way of a lot of it. Now, I've had these arguments or discussions with people about, how beneficial these things are. And there's one side of the argument that says, well, if you implement these kind of regulations, business is going to go elsewhere. We'll see liquidity dry up in the market. But then on the flip side of that, you say, well, we don't want another financial crisis. And, the market has become so big and unwieldy, and there's so much speculative activity, maybe some of it framed as hedging activity, but it's really spec. So where do you think the truth lies in both of those arguments?
Well, in the middle. I know that's sort of a trite answer, but it really is. All these things, whether or not it's in our personal lives or in government, are about balance. And it is tough to find the balance when you do have. There are more financial service sector lobbyists than in any other sector of the economy. There's 10 lobbyists in the financial sector for every single member of Congress, 10 to 1. And the financial sector, as you know, has made more profits since the fall of the economy in 2008. Every single quarter, big time, more than any other sector. So they've got all the bucks to, one, litigate us to death sometimes and litigate other regulators when they want. Even if they think they're not going to win, they'll just push us off. And two, they have the money to contribute to their campaign war chest. And the financial service sector has more money going into campaigns than any other sector of the economy. So the odds are stacked against sort of the average guy and consumers. And so it's tough for us to, because you're only hearing from sort of one side a lot of times, is to get what is that balance? What is that middle of the line that makes sense? But we're trying, and that's why, to some extent, these things have taken so long, because we want to get it right. We don't want to just listen to one side or another.
Now, one of the big developments in recent years has been the advent of these index funds, these ETFs, and now the emergence of very large, you and I have talked about this in the past, these passive, long-only investors, pension funds, endowments, and some say it has completely changed the character of the markets, distorted it to a certain degree. I've had people on this show who are in the commodities business, actual producers, who tell me it gets harder and harder to hedge effectively because of the distortions of these huge pools of money. Is there anything that's going to be done about that?
We're working on it, Mike. We have talked about it before. There's really two market morphing, I think, sort of things that are going on in markets. There's these group that I call massive passives because they're massive and they have a long-only, pretty much, fairly price-insensitive trading strategy. And we've seen that. We saw it back in 2008 with crude oil. Unbelievably, the numbers of massive passive and the massive passive investment has increased even since that time. Now, I don't see any abnormalities right now in markets, but it is a problem and it's something we need to get a grip on. The way to do that is to limit that amount that any individual trader can hold, and we do that through position limits, which we're being litigated on that one, but we'll get them done ultimately. The second area is high-frequency trading, these traders called cheetahs. They are also changing markets in a fundamental way.
How so?
No longer is it these floor guys here at the stock exchange or at NYMEX or CME. Those guys are going away. If you're going to trade in these markets, you've got to have essentially a supercomputer, and you've got to get this intel in the milliseconds. These are millisecond markets. And I'm not saying that we should necessarily be against those things, but there's no fundamental analysis that's going on the human side within, a thousandth of a second. So I'm just saying all these things, whether or not it's massive passives or the high-frequency trading cheetahs, are something regulators need to get a full handle on and potentially do something. With the cheetahs, they're not even registered now. We can't ask for their books and records. Oh, we can ask, and they can tell us to take a hike. We have to get a subpoena. They're not even required to test their programs to make sure that if their cheetah programs go feral, they won't roil markets. And we all remember the flash crash of May 6, 2010.
Sure,
so there are some basic things that need to be done with the massive passives, position limits, and with the cheetahs, registration. And with all these guys, by the way, I think increasing penalties, fines, and as you and I have talked about in the past, some criminal authority to actually. Remember Beretta, he used to say, the detective show, used to say, if you do the crime, you do the time. Putting him in jail is not just a cost of business. That'll mean something.
Right. The cost of business right now is paying a fine, which is basically a low cost to these
puny
guys.
penalty.
Yeah, puny penalty. Exactly. But I think this whole thing, it's very disheartening for the public. It strikes at confidence when they see this activity and the spillover effect into the real economy. And I think most of the public is behind increasing regulation, but they really don't see it getting done.
It'll ultimately get done. The question is, does it get done in a meaningful way? I'm okay with us being thoughtful and taking our time on things. I don't like that it's taken so long, but I'm okay if we're getting to the right conclusion. What I'm not in favor of is sort of kicking things down the road, punting, or being involved in over-analysis paralysis that essentially wraps ourselves around the axle, and we don't do what Congress and President Obama told us to do to protect consumers, markets, and the economy.
Right. Bart, Chilton, very outspoken on regulatory efforts. I thank you very much for coming on the show.
Good to be with you as always.
Thank you. That's it for now, folks. This is Mike Norman saying see you next time. Bye-bye.